So should you be a DIY investor? With all of the fever that's been going on with GameStop and AMC and Reddit and Wall Street Bets, we thought it would be a good idea to take a quick minute and just examine whether or not you should be trying to tackle this challenging task on your own. And with that, let's get moving forward. Hi everyone, welcome to The Plan Ranger, where our goal is to provide you with informed insights and a reasonable approach for managing your personal finances. Now, before we dive in, if you haven't yet clicked subscribe and join the Plan Ranger community, please take a second to do that so that you can receive updates when we share new videos that are designed to help you make the most of your money. Lately, with GameStop and AMC and Reddit and Wall Street Bets and all these different things, a lot of people have been trying to pour money into some of these stocks through apps like Robinhood and TD Ameritrade and any trading platform out there to really take on investing on their own. And so seeing a lot of this activity over the last month or so, which has been pretty fun to witness, thought it might be a good idea just to take a minute and examine the idea of whether or not you're capable and should be managing your own investments, without the help of an advisor or anything like that. So this question can be kind of tricky because it's a little two-sided here. First and foremost, let me just address this. I think that almost everyone out there should have a small gambling account. What I mean by that is, and we talked about this in getting started investing with stocks in a video, one of our first videos we ever did actually, was talking about getting invested in stocks and having a gambling account. I'm a big believer that everybody should have something like that just because it's going to engage you in the market and the economy and how these things work and help you understand your money better, which is a fantastic thing. So should you be managing your own investments, maybe the small gambling account with $1,000, $2,000, $5,000, $10,000, depending on how much money you have, and when in the grand scheme of things, let's say you've got $100,000 or $1 million or something like that you're investing, maybe no more than 5% of your total portfolio should go into that gambling account. And frankly, the more you get, probably a little less should go into that. It's more of a thing just to keep you engaged, right? You're not going to kill it with that or anything like that. I call it a gambling account just because you're there to have fun. You're there to buy companies that you like, and frankly, you're willing to pay to learn a little bit. I don't actually think you're going to lose all your money, although that is possible. It's more of a thing of just you're paying to learn, and if it doesn't go your way, it's okay. If the house keeps your money, that it is what it is. That's why it's the gambling account. But I do realistically think that even in your gambling account, you'd probably stand a decent chance of making more money. Better odds than in a casino, at least. Now, outside of that gambling account, what should you be doing with the rest of your investments? We're talking about things like maybe your retirement accounts, like, here in the US, your 401ks or your 403bs, your 401as, all these, your deferred comp, your regular investment accounts that you might have with a brokerage account, an IRA or a Roth IRA. Should you be managing those investments on your own? The lion's share of what could provide for your future. And that's a little bit more of a challenging question. Let's start by kind of the two functions here, looking at this two ways. First, can you? Okay, can you do these things? Are you capable of them? I actually believe quite a few people more often than not might be capable of doing it if they gave it a chance. But when we're talking about whether or not you're capable, it also depends on how you're going to invest inside the account. If you think you're going to show up and beat the market, if you think you're going to show up and produce portfolio returns that are going to exceed that of a professional's, chances are probably not, would be my guess. If being a gambling person, if I were to say, would you stand a chance of beating the average advisor out there, the average investment professional? Chances are probably not. And so this is where I guess, can you do it? Most people can't. They stick to some very fundamental things, such as maybe using low-cost index funds, trying to hold very basic portfolios that, through the use of these index funds, create a well-rounded portfolio that's in alignment with your risk profile, okay? Which we won't dig too deep into that right now. But if you keep it basic, if you keep it fairly vanilla, then yeah, most people probably could do it. The second you start deviating outside of that, though, outside of the vanilla, let's just call it, or the basic, you really need to start asking yourself, why are you doing that? Are you doing it because you enjoy it, it interests you and you find it engaging? Or are you doing it because you think you're smarter or better, or just have an idea that you're going to outperform, you're going to beat the market or beat advisors or something like that? And in those situations, we need to touch on your capability a little bit. Are you familiar with things like PE ratios, price to sales, price to book. Do you understand how dividends work? Do you understand asset allocation? Do you understand correlation coefficients? Do you understand, an efficient frontier? How and that's just on the portfolio side, along with alpha and beta and Sharpe ratios and all these different things. Then you move over to the economy side, and are you gonna, do you understand how the economy works and the connection and how the economy interacts with the stock market? Because they're connected, but they're not one on top of the other equal, right? Which is why so often we'll see disjointed movements, where more recently after the pandemic, the stock market has absolutely taken off, even though we still have exceedingly high, unemployment rates, and for all intents and purposes, the economy is just not doing that great. So do you understand kind of these connections between these things and how they all work together? And within that, do you understand the difference between investing and trading? All of these functions that I'm talking about, all of these, ratios and metrics, they're all attached to the idea of being an investor. A lot of people lately, when we look at GameStop a year and a half ago, people getting in on GameStop back then when it was $4 a share or something like that, those people were probably investors. They were saying, hey, I believe this is a better company than what it's priced at. I'm going to get in now. Versus what we've seen lately, which, is a little bit of almost a political movement in a way, but that was much more trading, right? Those people weren't getting in on GameStop because they ran the fundamental analysis and they see that it's undervalued or something like that. They were seeing an opportunity to buy and trade, a lot like what you see with cryptocurrencies and things like that. So can you differentiate the idea between being an investor and a trader? An investor's looking at the fundamentals of a company and they're saying, hey, I think this company is worth more than what it's being priced at, what the shares are, and I'm going to buy some of that. Versus the trader says, hey, I don't really care what this company is. I'm just looking at these charts and I'm seeing how it's moving, and I think there's an opportunity here to capture upside on the movement, right? And so, fundamentally, you need to kind of understand the difference between these two things too if you're going to be a DIYer. So the other part of this equation is, should you be a DIY investor? Not can you, not are you capable, but should you be doing it? And that's really a function of, do you have the time and the volition to put into this, right? So let's say you know how to do everything, you know where to get your research from and how to source good information, not opinions, but information, and so now are you going to take the time to really dig into that research, to dig into that information? It's a lot like a thing where, I could probably change the oil in my car, but I choose not to, because you know what? For the price, it's easier just to take it down the street, have somebody do it there, know that it's going to be done right, and pay for it. Yes, of course, I'm paying more to have it done than if I'd done it myself. But what if I miss something, right? What if there's something that I don't know that I need to be doing? I mean, sure, I could probably change my oil most of the time. But people, when they're under your hood, they're going to see things not just oil related that could be related to something else that you might not be aware of. And that brings us to the next point, which is the unknown unknowns. When you venture out into doing things on your own in any realm, really, not just personal finance, but in our instance, we're talking about here investing in personal finance. There are the things you know, and there are the things you don't know. But then there's the things that are the unknown unknowns, the things that you don't know that you don't even know exist, right? And those are the things that can really get you. And this is perhaps where maybe having a professional come in can really deliver some value. So much so that, in fact, even Vanguard, which is possibly the greatest bastion of DIYers, and any investment professionals love Vanguard too. The entire investment world uses Vanguard, but really DIYers, the do-it-yourselfers, flock to that firm more than almost any other firm out there. Even Vanguard has done studies which show that your advisor provides on average about 3% worth of value, on an annual basis, which there's a lot to be said for that. Between things like proper tax allocation and tax loss harvesting, asset allocation, things along those lines, advisors can deliver value, and they can also help you understand things that are the unknown unknowns, right? That you might not be aware of. Additionally, an advisor can also come in to help you with one other big thing, which is behavior. When you're considering whether or not you're capable or whether you can or should manage your own investments, you really kind of have to be truthful with yourself and be honest with yourself about who you are, and are you going to be able to ride out the tough times? Are you going to be able to, sit on the sidelines and not do anything, which is in most cases what you might want to do when things get tough, when the market gets tumultuous? In the example of the trailhead, when we're talking about, the meadow, the foothills, and the mountain is not only the tallest and has all these sheer edges because of the volatility you might expect and the potential rate of returns, which could be higher. The mountain also represents an obstacle that is, by definition, just more complex to navigate. The meadows are easy. Walking through a field, almost anybody can do that. Anybody can go to a bank and buy a CD or open a savings account or something like that. It really does not take much financial knowledge to do that. But when you start talking about traversing something as massive as a mountain, all of a sudden, my hope is that it'll dawn on you that that's a complicated task that not just anybody, certainly somebody who's never done it before, should try and do on their own. You'd probably want some help. You'd probably want some guidance, and there's nothing wrong with that. Especially when it comes to managing your behavior. If you're up there on the mountainside, when all of a sudden a storm rolls in and everything basically goes to hell, it can be very handy to have somebody for you to talk to that can provide you with a constantly informed opinion from other informed, resources out there that can help you stay the course so that you don't get washed down the mountainside and lose a bunch of money, right? They can keep you on your track, which is great. Not saying you have to do that, but if you don't have that control, if you can't control your own emotion there, it really might be worth considering. Finally, I'll throw out this one last thing here, which is even if you choose to manage your own investments, if you choose to go that road and be a DIYer, that's fine. That's all good and well. I wish you the best of luck, really. I think, like I said, I think some people can do it. It's just a question of, not only if they can, but should they. If you choose to do that, it is still worth mentioning that you should get together with maybe a financial planner, ideally a CFP or certified financial planner, every year or 2 or 3 or something like that, just to check in and look at you as in your entirety, right? So taking on one asset of your personal finances is one thing, but trying to handle all of these things, honestly, that becomes probably too big a job for your average person, even your above average person, just because of the sheer time involved between all of the changes in tax laws, estate laws, the policy changes that can come out there and rates, and then you start talking about investments and your cash flow and your debts and how all of these things intertwine together and how they all connect together. That is really where everything becomes extremely cumbersome. And let's just say that if it's not that you can't do it, but you're gonna, there's gonna be stuff you're gonna miss. Ultimately, what all this comes down to is that old proverb, which is, the story of 2 guys sleeping by a campfire in the jungle, and all of a sudden they hear a lion. The lion starts running at them, and the 2 guys start running off. The one guy looks at the other and says, "There's no way we can outrun this lion." And the guy replies to him back, "I don't have to outrun the lion. I just have to outrun you." The advisor or professionals that you deal with, whether it's a financial planner to help you with everything altogether or an investment advisor, fundamentally what you have to ask is, can you outrun that person, right? And in most cases, you probably won't be able to. They're just going to be more informed all of the time. It's what they do all day long for the most part, So keep that in mind as you go forward and question whether or not you should be doing this. And if you want to get on all the Reddit and the Wall Street bet action, good for you. Maybe do that in your gambling account, just maybe not so much in your retirement accounts and things that are going to provide for your future. Okay. Hopefully that takes care of that. If you have any questions, please leave them down below in the comments. As always, click like, subscribe, join the Plan Ranger community. We would love to have you, of course. And if you know anybody else that's thinking about becoming their own personal DIY investor, please share this video with them, and hopefully, you can help us help them. Until next time, thank you very much for taking the time. We hope this helped.